Technically late.
Oh, hey, everybody. Sorry, we were a minute late. Just in between meetings and all that kind of stuff. So you guys know the drill. We actually have a fair amount of stuff to talk about today. And it goes beyond the clashes. Should I stay or should I go? But do I wait or do I go? That has been kind of this recurring theme that I've heard a lot in the last 4 or 5 days. So we're going to address that. Plus there's new stuff. So as you are ramping on here, thank you for hitting the Q&A button with questions. We'll deal with those. And if you want to harass us, that's fine too. Hit us on the chat. So Jack, you seem to have some new things that you wanted to talk about. You want to start us off and then we'll kick it over to Adam and then we'll go into questions?
Sure. So yesterday, there was a publication, I want to make sure it's yesterday's date, that, and it is a revenue ruling that, we've had a lot of questions as to whether or not the deductibility of forgiven loans is going to happen or not, with the theory that, or the reality is that if, they're giving in one hand, taking away in the other. And so there was this IRS revenue ruling that came out yesterday. I think it was yesterday or the day before. And I'll just read the holding. A taxpayer that received a covered loan guaranteed under the PPP and paid or incurred certain otherwise deductible expenses listed in the CARES Act may not deduct those expenses in the taxable year in which the expenses were paid or incurred, if at the end of such taxable year, the taxpayer reasonably expects to receive forgiveness of the covered loan on the basis of the expenses it paid or accrued during the covered period, even if you submit an application for forgiveness by the end of such taxable year. So now, as we're getting closer to the end of the year, they're saying, we understand that you may not know if it's forgiven or not. And so whether or not it's deductible or not is going to depend on whether it's forgiven or not, and you will not know that. However, what they have stated, I think clearly in this revenue ruling, is that if it is forgiven, you cannot deduct it, period. And if someone else is interpreting it differently, but right, and of course, subject to change, because you will have, and I have examples of, and I've read that there are certain groups that are protesting and continue to address this particular situation, like chambers of commerce and other organizations are saying, wait a minute, this isn't what the intention was. All the things we've talked about over the past several months, essentially. So that came out yesterday, and I think it was a little bit of a shock that they came out and said that it's not deductible, because I think that they should have waited, I think, a little bit longer until the second stimulus package or the program comes out, and maybe say, okay, and kind of fix that. And maybe that's the way that they do it. Package number 2 fixes the fact that you didn't get the deduction previously, but that is a mismatch, because there may be some people that seek a loan now that didn't before, or maybe the other way around. And we'll talk about also the, I think as we've discussed, there's a lot of questions about, as you said, should I stay or should I go? Should I submit or should I not? And we'll get to that a little bit later. But I also have some explanation as to why you should at least wait until Wednesday, and we can talk about that in a moment. But I just wanted to share that kind of breaking news first.
Man, that's good. I wish we had the graphic of the breaking news and had the sound effects, but we're still pretty low tech. Adam, you want to jump in on anything before we get to questions?
Yeah. Obviously, I try to give up swearing in I'm not gonna, but this is a crock of shit. Anyhow, I'm speechless. Because it basically, like, you had me at, hey, we're going to take a really obscure position around the deductibility of the expenses and run with it. Okay, got it. At least there was precedence. In this case, on the one hand, you've got the SBA saying, hey, we're not, like, what are you supposed to do if you're a greater than $2 million taxpayer and it could be a loan? You don't know if it's going to be forgiven or not. Because you're going to go under audit and you have to fill out this massive questionnaire. So just, it's a complete mismatch between the reality of the facts on the ground with the SBA and then the reality of what, you know, the IRS. Another one of my favorites too that just came out also in October from the SBA. Again, the writing had not known. I didn't know this was going to just turn into a bitch fest. So sorry about turning it that way. But another great one is that, Joe, I could really use that Pappy Van Winkle, by the way, if you're on. Another great one is that on October 2nd, the SBA told all the banks that, hey, by the way, if you have a customer who you have an outstanding PPP loan with and they happen to sell their business, and by sell, we mean substantially change the character of their business by 50% or greater with either an asset sale or a stock sale or whatever, which would also presumably incorporate people buying into an existing operation, that money has to go into escrow times 10% prior to closing. So you have to take operating funds that you deployed for PPP, stick in an escrow, wait for your forgiveness, and get your money back. So think about the people that are in that position that also are trying to make a tax payment because, well, here's my source of funds associated with making the tax payment that are now in freaking escrow until I forget not for when my transaction closes, which would be a typical escrow. It's when the SBA finally gets around to approving my loan, or the bank receives the funding and the green light from the SBA that, hey, you're good to go, which is, I can't remember what it is, either 90 days or 120 days. I'm like, this is just madness, absolute madness. So I really don't see this one standing at all. It just can't. It's just wrong on so many levels. So, Jack, bring us some good news about Wednesday.
All right. So here's let's talk about how things happen. So last month there was this form that came out that started freaking people out and basically said, well, yeah, loan necessity questionnaire, 9 pages long, check the box, provide these things. And when you start reading it, it's like, oh, okay, they want me to reiterate the information from Q1, Q2 of 19 to 20, those things that I did to basically get the loan. Then you go into next several pages and it's like, at any time since March 13, 2020. And then you have at any time since March 13, 2020 through current, essentially. Did the borrower do any of these things? And talking about payment of money, outflows of money from the company. And as you go through this, you're like, maybe, maybe not. And so, you know, people are panicking, and the question has come up for all of us as to, do I, submit or do I wait? Well, first of all, the first question is, have you received the information you need or the green light from the bank in order to proceed forward? And so receive the questionnaire from the bank. But as a matter of federal law process, so on October 26th is when this form came out. There has to be a 30-day comment period for that before it actually goes into implementation. And what that allows people to do is to, and I'll give you the list of things, and don't laugh about this. All right. Whether the collection of information is necessary for the agency to properly perform its function, whether the burden estimates are accurate, whether the ways to minimize the burden, including the use of automated technologies, whether the collection of information is necessary. So that is the key, okay? And so you have, as we said, all of these organizations hitting the SBA Treasury with, why are you doing this to us? So, even though we think we know what the questions are, this form is not in final form, maybe. And so when I think my recommendation, kind of getting to the end, is that you need to wait until next week at least before you really do anything. And so leaving a cliffhanger in the, a few minutes into the program here, that, yeah, you got to stay tuned. I don't know if we're going to do a Thanksgiving special or not, but I think it'll probably stand, because if you look through the literature as to what the purpose of this is, it goes back to trying to find the people that have stolen stuff essentially from the federal government and really didn't need this. The problem is that when all of us submitted these applications, when we submitted potentially our forgiveness applications that they've been submitted, it was all focused on going back and looking at that period of time. Actually, 2 periods of time. It was in certain comparisons, Q1 and Q2 of 19 and 20, but then it was also looking at this very specific, either 8-week or 24-week covered period, and the need during that period of time, despite the fact that you may have gotten the money after that or prior to that, whenever, usually after that. So now they're going back and saying, we want you to look retrospectively at whether or not you really need it. How did things actually happen? So on the one hand, that's kind of a fair question. If you really didn't need it, it's kind of like having an insurance policy that you didn't tap into. Well, you got to maybe give us the funds back because you really didn't need it. And, the flip side of that is, well, in addition to receiving this money, we worked our butts off to be efficient, to protect our people. We implemented certain things, and we gave our customer constituency assurances and provided services. And so there was not a break in the action of providing goods and services, whatever the reasons are. And so that is the problem, to go back now and say, well, as it turns out, maybe we really didn't need it, but it's maybe because you made certain decisions that made you fiscally better off now than you might have otherwise been, regardless of the additional money. And then you have the issues that we've talked about that, and it isn't a part of it officially yet, is, did you have other sources and ability to get funds? We're talking about the retained earnings account, or as I've said, with an S Corp, leaving the money in there post-tax, as using that as your savings account, kind of sort of a retained earnings account. And so, that cash that otherwise may have been used by the owner to go buy a boat, a house, whatever. And so you have all these issues coming about. That's a kind of a long-winded way of saying that I think you shouldn't do anything until next week, at least until this is the final form. And then I still think that there's going to be changes coming forward, either with version 2.0 of stimulus money, or a reach back into 1.0 to make changes, including maybe changes to the form. I think there's going to be another revisiting of the deductibility or non-deductibility of those expenses. So that is a deeper dive into whether I should stay or should I go.
Well, let's hope that they do that, because otherwise we're going to have another rant fest from Adam, and that's just not pretty. Hey, so Jack, I'm gonna throw this out to you, unless Adam's photographic memory knows this one, and then we're gonna move to the next one while somebody's looking at this. But this references line 6 of the PPP loan forgiveness calculation form. And the question is can line 6 of the PPP loan forgiveness calculation form be greater than the loan principal? That's the question. Anybody know off the top of your head, or do you need some time to research that?
I'll stall while Jack looks up what line 6 actually is. But if you just flow through the form, if line 6 is how much did you really spend in totality, what you spent can be in excess of the principal balance of the loan. And if you had any sort of reduction associated with it, the reduction quotient applies to the amount that you actually spent, not the amount of the loan. So if you had a really big amount, but then had a reduction quotient applied that then reduced you're still comparing that reduced amount or whatever you really spent to the forgiveness amount. But at the end of the day, the max that can be forgiven is the loan amount. Was that a long enough stall for you, Jack?
Yeah, I think so. Okay, so I'm going to give you a lawyerly answer, which is it depends. First of all, I assume we're talking about either the 3508 or the 3508 EZ, because I don't think the 3508S, which is the 50,000 or less, has a line 6. But line 6 in the EZ one is actually the loan amount, and line 6 in the full version is calculation with respect to adjustments for full-time equivalents. So 2, 3, and 4. So if I'm reading this correctly, the question, if it's on the original application, it is the sum of the costs. Yeah, I'm thinking that it is maybe whoever asked the question can ask for, we can ask for clarification, but I think it's line 6, PPP loan amount is simply the loan amount that was provided to you, the loan funds. So I'll wait and see if there's a clarification on that question.
Yeah.
Okay.
And just to reiterate, I mean, you sum up what you really spent. I mean, you don't not sum up what you spent. And there is a scenario where what you really spent is greater than what you got in loan proceeds.
All right. The next question is, if this year we're going to have a low profit and they're an S corp, wouldn't it make sense to pay taxes on the PPP in 2020 versus 2021 tax year, assuming next year is going to be more profitable and the individual tax bracket will likely be higher? Can the IRS argue that the taxes should be paid for 2021 tax returns versus 2021 or 20?
You missed the first part of the call. Well, so with the late night poop drop that just came out from the IRS, what they're saying is it doesn't freaking matter. It's 2020. Like if your covered period so it's going to be, so in other words, what that's basically saying is that for a limited number of people, you should pick this up in your 2020 income, whether you've received actual forgiveness or not. So all the other webinars that we've had where we've advised delay because let's wait to see what happens. We're still advising delay, but Gary, don't hate me for this, but this is sort of like court cases getting thrown out over the election. Like the window is starting to close with the IRS saying, no, if you want to try to stall submitting your application to have it skip a tax year, we're wise to you. You can't do that either. So the only way that this is going to get fixed is through legislation or a court case, frankly. And, both those take time. So in this particular instance, you aren't gaming anything by moving it into next year by having a low income year. So it is a good question though, is that if it was going to be income, are you better off picking it up in a lower rate environment? The answer to that is always yes. The reason we said delay was not because of the tax rate potential difference. The reason we had said delay is that it is unknown whether or not the expenses will be deductible. So if they are not going to be deductible, why wouldn't you at least have the option of delaying writing the check between April 2020 and April 2021? And we really thought with almost all certainty that the expenses would be deductible. And I still believe that. I don't believe Trump won the election, but I do believe this. Sorry, Gary, again.
Time will tell. Time will tell.
So then, you kind of come down to the question again. It still comes back to a time value money equation. It's like, if the marginal income from PPP bumped you up from 25% effective rate to 30% effective rate because the IRS won, I lost. I and every other freaking business lobbying group, trade group on the planet lost, and the IRS won, which I've never heard of happening, but it could happen. By the way, bipartisan agreement that the IRS has this wrong. Let's just throw that in there too. Then what you're really debating is, what did I make on that 5% difference in the effective tax rate? Honestly. So our delay was really based on thinking this would ultimately go our way. And if it didn't, your tax rates would be neutral. But, as with anything, if you don't believe your tax rates are going to be neutral and you believe that you'll be in a higher tax bracket the next year, not because of a rate increase. We do not still think rates are going to increase in 2021. Could be freaking wrong again on that. But if you are naturally going to move up because we have a progressive tax system in the US, that's the same thing as a rate increase. And you just ought to look at way one versus what I make on the money and then paid at a higher effective rate, or way two, I took it at my 2020 effective rate, and just see which one leaves you with the most net cash in your pocket. We have a webinar or a explainer video on our YouTube site that goes through the math problem associated with performing that calculation if you want to take a look at it.
All right, good. So I love this. Whoa. Did Jack just say that you can count the loan as forgiven in tax year 2020, even if it's not forgiven?
Yeah, that's exactly what the IRS said. So Jack, if you want to rant, now's your time.
Yeah, I wish. No, you can't count it as anything. You have to basically punt it until. What they're basically saying is that if it is forgiven, it is not deductible. That is what they are saying in this document. So essentially it's a wait and see. And I don't know, most people are not going to get notification that it's been forgiven. So it's basically saying you got to wait until next year. I think there's a question in the queue about, well, what if I treat it one way now and then kind of make up, potentially reserve the right to make a change down the road, but we'll get to that. So yeah, that is what I said.
So next question up says, my PPP loan falls into the lowest category of dollars, meaning I can use the express filing form to seek for forgiveness. My bank has sent me a request to start processing my application. Should I go ahead with the request or should I wait?
Well, so again, if you look at this revenue ruling, what the revenue ruling says is that if you submitted and you have a reasonable expectation that it's going to be forgiven, and even if you have not submitted but you have a reasonable expectation that it's going to be forgiven, then it's income. So again, in 2020, income meaning you can't deduct the expenses. So just make sure we're all clear on that. So, from our perspective, the reason for delaying is we think that this shall not pass. To quote my Lord of the Rings, take that, Jack. You shall not pass. Get off. So, not to be a jerk, but screw them. Submit at 12:31, 11:59 a.m. because you're not actually going to have to, really, you're not going to have to make the call on this until you make your extension payment on April. I mean, if you're a C corporation, different set of rules. If you're large enough, you're supposed to be paying as you go. So that's kind of a different math problem. But if you're, standard flow through entity, you're not going to have to make the call on this until April of 2021. Thus, whether you submit the stroke of midnight or you submit at 12:01 a.m. 2021, it doesn't freaking matter anyway at this point with this revenue ruling, which is my take on it. Thus, again, you're still not receiving a medal for submitting early. You might as well wait for some more clarity to come out. What do you think, Jack?
Yeah, I think that it's, they try to be clear, but all they're doing is basically punting it down the road and saying, wait and see kind of thing. And also reserving their right. So if it ends up being, again, because I think if it were not November 19th, we may not have received something like this. It would be, okay, let's wait and see. But I think they need to people are saying, okay, what do we know for sure by the end of this year for tax year 2020? And what they're saying is for sure that, like anything else that is forgiven, and then most things are forgiven in the business world, that is a taxable event. And so now it's really just a matter of waiting whether it was forgiven or not forgiven. But that is basically applying the tax code with blinders on and saying, well, it works for everything else and we're going to apply it here, but doesn't bring into the subjective factors of why this was put in place in the first place and what that really means, which is they've given a benefit and taken it away. So the net benefit is zero or close to it. So I think there's more to come with that, as I said before.
So before I read the next question, this has been a good session with really good questions coming through, and I'm reading the queue, they're good. But I think because it is Thanksgiving next week, I'm electing that we will not be broadcasting live. We want you guys to go be thankful, and then we'll get back on the crazy train the following week. But unless I hear a resounding no, that's what we're going to do. And I'm just saying that now because people dial in and dial out of this thing. So, hey, Richard, good to see you here. And here's Richard's question. I can't always tell when we're talking about $2 million plus loans or under $2 million loans. Can you clarify which of these audits and burdens of proof will apply to under $2 million loans? Will applicants of less than 2 million have to answer whether in retrospect we really needed the money? And I'm not talking about small auto forgiven loans.
Yeah, so the way that works is that if you were less than $2 million, you're still certifying under penalty of perjury that you needed the money with no real clear definition of what needs the money actually is, other than to look to the big questionnaire that they're doing for above $2 million loans that you're supposed to fill out. So, you kind of assume, well, it's probably the same criteria. So below 2 million, you're still supposed to certify that you need it. And again, Jack and I both think, well, I can say it because I'm not an attorney that could get disbarred, and I don't think I can lose my license for this. I think it's BS because it's, looking in hindsight, thanks, armchair quarterback. That's great. You know what? I should have won the Super Bowl last year. So you come run my business then if you were so good at predicting the future. There's a reason people work at the IRS, by the way. I'm probably going to rot on that since we have a couple clients under audit right now. So for lower than $2 million, it's supposed to be the same kind of, hey, thought process. It's just that nobody's going to come looking as it reads today. And they're assuming that you made a best faith effort when you requested the loan. Therefore, if for some reason it was determined that it's not forgiven, it just turns into a loan. There's no kind of penalty or something like that. But you're still supposed to be saying, I really did need the money in retrospect. It's an on your honor system. So I see no reason why anybody wouldn't check. No, hell yeah, I needed it. So what they're targeting in that class of people are the fraudsters. I submitted, falsified payroll records that ginned up my payroll to get myself, a $500,000 loan. And I did it over and over again for these businesses that I just had created that didn't really have any activity, but I falsified payroll records for employees that don't exist. And I got money. Like that's the cases they're prosecuting in this category of when you read the press about fraud, that's what they're talking about. So then when you get to the greater than $2 million category, you do have to fill out a pretty extensive, whatever, I think it's 8 pages or so, Jack, questionnaire that at the end of the questionnaire, it's not like it's a freaking decision tree that says yes or no. It's just a questionnaire that asks you a bunch of comparative information about your sales and funds that you may or may not have had available at the time with no actual decision. It's just a data gathering form. But I mean, I don't know, reading it, again, I can pick on attorneys since I'm not one, having had to do a deposition before and coming away feeling as if I shouldn't even be a CPA or practice in the business of public accounting is all because opposing counsel made me feel like a freaking scumbag. That's exactly what filling out this questionnaire feels like, is that I'm the worst person in the world. If I was relatively flat. How was I supposed to know that was going to be relatively flat? And where's the question about what does the future hold, which is the fundamental basis of the loan in the first place? So with greater than $2 million, you fill out this questionnaire, and I'm on a roll today, Gary. You fill out this questionnaire.
Man, I like it.
you fill out this questionnaire, you submit it to your bank. No guidance on what the hell the bank's supposed to do with it other than submit it up to the SBA. And the SBA is currently saying that these loans will be audited. For what? I don't know. I mean, supposedly they had this questionnaire. What, some knucklehead supposed to tell me that I needed money or didn't need money based on some arbitrary set of criteria, as Jack has already so eloquently opined on, that is substantially unfair. So there's no way that doesn't go to court, because I mean, hell, I would start a legal defense fund. Somebody start a PAC so we can start a legal defense fund to defend people who were wrongly made to give back money. I guarantee something's going to happen to that effect. So that's what we're talking about with greater than $2 million, is that they're in below 2 million, you're just checking a box. Above 2 million, you're still checking a box, but you're answering a million freaking questions about what made you decide to check that box, saying I really did need the money. And presumably, that, not to use fear tactics, but if I'm filling out that questionnaire, it's like, wait a second, why am I putting this rope around my neck? And I'm telling you, it's not what's going to happen with this. What's going to happen with it? Why are they moving that horse underneath me? Why are all these people gathered around? So that's why it's also substantially unfair to talk about this whole tax thing. It's like, the way this revenue ruling reads, if I'm above $2 million and I reasonably expect to receive forgiveness based on everything else, but then I had to fill out this questionnaire, I know I'm getting audited, do I actually have a reasonable expectation at this point? Same thing for below 2 million. I'm just checking a box, but look at the greater than $2 million questionnaire. That's freaking crazy. And what the guidance says preceding this is that, hey man, you don't have to give the money back. We're going to assume that you took out the loan in good faith and it'll just become a loan. What the heck?
Yeah, so two things tied to that, which is the application also includes what did you do with the money, not just what your expectations were. They want to know what you did with it, which is, you think, okay, well, they're the lenders, so they should be able to, you should tell them that. But, what are they going to do with that information? Because again, the point of this was to look at, I think, 2 periods of time, which is comparison of 2 quarters, year over year, and then the actual period of time that you said, the money was to be used for was used for. Now, there is, just to give you a better idea of what's on this form, assuming that several of you are in that $2 million or greater number. So they put it in different categories, and they call it the business activity assessment. So that's documentation of gross revenue, explanation of effect of COVID-19, essentially. Liquidity assessment, your cash on hands, dividends and distributions, outstanding debt, highly paid owners and employees, value of the borrower, ownership, and then other CARES Act benefits, meaning did you get money from other programs? So, I mean, that's an encapsulation of what those questions are. But, and again, at least for now, maybe by Wednesday or then after it changes. So we don't know.
All right, just a point of clarification to the scenario earlier. I think it was on line 6. They clarified it was form 3508, Jack.
I knew I wasn't going to get off the hook that easily. I'm going to stick to what I've said from the very beginning of this, which is I'm not, first of all, not qualified, but also I'm not going to do math on the fly, because all those calculations, you have the main sheet, you have the worksheet, then you have the spreadsheet, and you have the worksheet to the spreadsheet. So all those numbers interact. But happy to discuss with whoever that is to help them through that, or you guys can. But yeah, because it's cross-pollinated, and I don't want to go through the math and make certain presumptions. That's why I use spreadsheets.
So there are two questions that are kind of related, and you can determine whether you want to do this or not, Jack. If Jack chooses not to, rewind the tape and watch the beginning of this broadcast. But could you please repeat the name of the new ruling that just came out, you know, in the middle of the night? Kind of like some votes, I guess. Anyway.
Both directions, Gary, both directions.
So, and then the question was, so if you could do that, could you reread that pronouncement about the taxability?
Yes, definitely. I'll give you, so it's Revenue Ruling 2020-27. It came out, I believe, yesterday. It may have been technically the night before, but late in the night. So in the past 48 hours. And the summary of it is, the holding is a taxpayer that received a covered loan guaranteed under the PPP or incurred certain otherwise deductible expenses listed in the CARES Act may not deduct those expenses in the taxable year in which the expenses were paid or incurred. So in other words, you incurred those expenses in 2020. If at the end of such taxable year, the taxpayer, meaning the end of this year, taxpayer reasonably expects to receive forgiveness of the covered loan on the basis of the expenses it paid or accrued during the covered period, even if the taxpayer has not submitted an application for forgiveness of the covered loan by the end of such taxable year. Now, they do give you two examples, and one is not having seeking forgiveness. Let's see, but it goes back to the reasonable expectation of reimbursement. I mean, and so again, punting it down the road. And it also talks about, has some prior cases as to why forgiveness is deemed an income event or, a taxable event. And it goes through some of those cases and tries to put that logic into this situation. Again, completely ignoring the reason why the money was given in the first place to people.
My favorite actually is the frickin' contingent fee case. Like they use a case from a contingent fee attorney that front loaded some expenses that would get repaid if the case was won. Of course that's freaking income and you can't deduct the expenses. It's not a global damn pandemic where you're trying to get me to keep people off unemployment. Totally different set of circumstances. Or I could say it a different way. Of course the attorney screwed it up for everybody else.
Why are you getting so down on us today?
You are on a roll.
I know you mean everyone else except me, so that's okay. I know
that's right.
Yeah, my Fitbit actually said I got a good night's sleep last night, so I don't know what the problem is.
Yeah, mine said mine was very poor.
Yeah.
So this is from Bob, and this was earlier, so maybe we've addressed it, but so here's the specifics. His fiscal year ended 9/30/2020. The return is due 12/15/2020. The intention was to deduct payroll and expenses as in past years and show the PPP as long-term liability. When it's forgiven in this fiscal year, 9/30/21, I will or will not declare it as income. Is that the right approach?
No, because I think with this, so in this, I mean, you're going to have to just make a decision a little bit sooner than everybody else in terms of how you want to treat it. But if you were to follow the intent of this revenue procedure, the window of time that you're looking at is actually your covered period. Meaning, like, if I use the 8-week cover period, if I use 10 weeks, if I use 12 weeks, if I use 24 weeks, that's your time window. So if that's the time window that you used, it matters when that time window happens. So if your time window happened before the end of your fiscal year, it's in your 9/30 year end. If the window happened and it spanned, you've got part of it in one tax year, part of it in another tax year. But I don't think there's a single circumstance pursuant to this revenue procedure or revenue ruling, which again are not binding, by the way. It's still just the IRS's interpretation, just a little bit more grounded than previous things they've released. So it's not, the game's not over till it's over.
Right on.
So in your particular case, assuming that you spent the money before the end of your fiscal year, you really need to pick it up in this fiscal year, not, let it span into the subsequent year. But all that said, we still think that this one's BS. So in your case, I probably, again, if it was me having to fill out the return, not as your pay preparer, but as the business owner, I probably would extend the return. I don't know if I would make the estimated payment or the extension payment or not with it. And I would just, kind of let things play out a little bit further. But I think what this is saying is, for right now, the IRS is saying it doesn't matter when you submitted the application or not. That's completely decoupled from not being able to deduct the expenses. Not being able to deduct the expenses is tied to when you spend them, period.
And I think as a follow-up to that, and as this is obviously new to us over the past 24 hours or so, so we're kind of looking into it and re-looking at it. To David's point in the chat, so I'll give him credit for it. If we read the literal words of the holding, it says, may not deduct those expenses in the taxable year in which the expenses were incurred if reasonably expects to receive forgiveness. So it may be that the taxpayer doesn't have a choice to do, because I see some other questions about, well, what if we do it this way and then we can always amend it later? I think it's that you can't do it if you think you're going to get forgiven at this point. But again, subject to interpretation of what that really means. But at this point, maybe that the choice has been made for you that if you think you're going to get forgiven, that you can't deduct those expenses. So as Adam just said, maybe you do the extension and see what happens. Again, we're in a new place with new president. And so, things are going to change one way or another.
Right.
So just to interject a real quick note on the chat. Thank you, Karen, for the encouragement. She said, at this point, I'm pretty sure I now know more than I ever deemed would be necessary at my age. However, you guys are awesome, brilliant, and at least made it fun. Many blessings to you and your families, to you too. Karen, thanks for that. And David, thanks for always keeping us honest and adding some spice to the broth here. The next question is, following S-Corp tax question, if we pay it on 2020 and then the Congress directs the IRS not to tax the PPP, can we amend the tax returns after? We just did talk a little bit.
So you go back. So I'll just reiterate the point because, it bears repeating until it, because then I can have a tirade again. But, where this is really going to show up for an S corporation is when you're making either your January 15th estimated payment or an April 15th payment with either your return or your extension. So with the January, what it's saying is it is 2020 income, because most all of us spent the money in 20. I mean, by default, you pretty much spent the money in 2020. If you got a loan, you spent the money in 2020. It's 2020 taxable income is what they're saying, regardless of this disposition of the forgiveness, unless you think you won't be forgiven. So where it shows up is when you have to make that January 15th payment, your estimated payment is based on 110% or 100% of your prior year tax obligation, or alternatively, 90% of the current year. So if let's say, keep it real simple. Let's say that you made $500,000 in 2019, and that was the basis of your estimated payments for 2020. And this year, life sucks, and your income before PPP is $250,000. Our advice to you would have been, hey, let's shave those estimated payments down, because we're only going to have to pay taxes on $250,000, not $500,000. But if your PPP loan was $250,000, your estimated income is now $500,000. Thus, it is the same as last year. Therefore, you would need to make an estimated payment to avoid penalties and interest on January 15th to get you square. off the prior year, which is ridiculous. Same set of facts. If 500 made 400, so I was down 100, but I still got 250. My taxable income is 650. Still have probably a little bit, still have my estimated payment on January 15th I got to make, but my extension payment or my payment due with the return is based off 650, not the 400 that I was planning on. So I think without this being resolved, you're in a conundrum on what you should pay relative to the cost. I mean, on the bright line, you can annualize the income so that it would negate most penalties and interest associated with it. But, you're kind of in a conundrum of to pay or not to pay the extension payment. It's against the law, technically. You're going to be subject to penalties and interest potentially. But you also don't really know the disposition of what's going to happen.
Next question is just for clarification, the loan proceeds, assuming forgiveness, are to be treated as non-earned miscellaneous income on the income statement, not on revenue, correct?
Yeah, I mean, if you think about how it's probably going to show up for itself, probably, they're going to have to change all the freaking tax forms, but probably what will happen is that you'll have all of your income, all of your expenses stated like you would normally state it. And then there's going to be, one probably adjustment line called PPP income received that is going to be, somewhere either on page one, probably it'll be another deduction item, could be on M1. We don't really know, but regardless, I can't believe that they would say reduce it from the associated expenses that you applied for forgiveness for. Instead, they're going to say your expenses were your expenses, and then here's one more number to add, which would imply that it's another income type item.
So the next one is from Richard.
Yeah. So let me go on a tirade again. The next shoe to drop is they're going to tell me that I can't use this for the purposes of calculating QBI, assholes.
Man, they have got you breaking your resolutions left and right, man.
Yeah.
Well, all I can say is if you've ever been to the DMV, and this feels reminiscent of that. Some of my longest days have been at the DMV.
Yeah.
Right. So this you'll appreciate this, Adam. So can I tell my insurance company that in retrospect, I didn't need their insurance policy, so send back my premiums and imply that they were trying to cheat me by accepting the premium in the first place and then require them to show me what they spent my premium on? It's actually a pretty good analogy. You are creative. And then he has a question here. Should our next estimated tax payment reflect this guidance? i.e., do we need to remit more taxes now to cover PPP?
I mean, if you want to follow the letter of the ruling, you should. At the same time, man, that's a really hard call to make. If you look at kind of your window of time, it's either I'm paying in January and then I can just carry it forward and maybe skip an April payment and skip a June payment. That's like the reality of what could happen if it goes you can deduct the expenses. The other version of that is, I just don't count it because I think it's going to change. And then I've got some penalties and interest and I make any April and June payment as I would in the ordinary course because they fixed this somehow. It's a hard call. If I was flush with cash, I probably would follow the rule. If I was strapped for cash, I probably would not. I mean, that's not me being your tax advisor. That's me being pragmatic business owner, because that's how you would have treated any other estimated payment anyway.
All right. So I've got two here actually from Jim. So here's the scenario. As a nonprofit, should I assume that the IRS will want to treat nonprofits as the same as for-profits and will want PPP forgiveness reported as unrelated business income subject to tax? And then
That's a great question. That would be a great inequity if it wasn't. I mean, but I don't know. I mean, technically, you would think that it would be UBIT, but obviously, way to go, guys! You didn't get the pronouncement. You didn't cover not-for-profits.
And then he has a follow-on question here. I thought you had to use an 8-week or 24-week covered period. Can we use a 12 or 16-week or something other than the 8 or 24-week covered period?
There weren't any examples or specific guidance on using something in between. But since it says when you're ready to submit, and you could submit before the 24 weeks, that the implication in that is that you could use a middle of the road period, but you would have to manually adjust all the other calculations in terms of determining whether you had excess comp and all the other stuff that goes along with it. In other words, you can't say I only use 12 weeks, but then use $46,000 as your test. You'd have to use the 12-week version of the $46,000 for your wage test.
Next question is from Ron. If a 24-week payroll is more than the PPP loan, is the amount over the loan tax deductible, and even if it was shown on the PPP loan forgiveness form?
Well, that'd be a real pisser if it wasn't, but it's that any excess that you spent should be deductible.
Yeah, remember that it's linked to what is forgiven. And if it doesn't get forgiven, then it doesn't fall under this proclamation.
Man, you guys did a really good job. We had 16 pretty good questions, thoughtfully answered, as well as with a few rants here and there. So, oh my goodness. If we didn't have all this, what would we be doing?
I do just have to tell you, what really, really, really frustrates me about this? There's bipartisan agreement that this needs to be fixed that could be completely decoupled from all the other negotiations coming on that are going on around, 500 billion or 2 trillion or $1 trillion versus 2 trillion. They never factored in that there would be any revenue receipts associated with this in the first place when they passed the CARES Act, which is why there's bipartisan agreement that the IRS has this wrong. So freaking fix it.
Right.
Like, this is a no-brainer to say, as a standalone measure called the HEROES Act Part 2, the Department of Treasury is stupid. One page, passed, done. Get the most votes ever in Congress. It's like renaming a freaking post office, for the love of God.
One thing that is related that I see in the literature a lot is going back to the frequently asked questions, in particular number 31, which came out in April. But in going through the logic behind or the arguments for and against this over $2 million questionnaire, they look at, and I look through this and it says things specifically before submitting the PPP application, all borrowers should review carefully the required certification that, quote, certain economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. Borrowers must make the certification in good faith, taking into account their current, the emphasis was by me, current business activity and their ability to assess other sources of liquidity, which that was back then. That is not part of the formula necessarily now, to support their ongoing operations in a manner that is not significantly detrimental to the business. And then it goes about demonstrating that need at the time. Again, current economic uncertainty, current ongoing operations. So, and now they are coming back and saying, well, tell us if your fate turned out as you thought, as badly as you thought it was going to be. And if not, we may want some of that money back. They haven't said that yet, but that's where they're going with this potentially. Or they could say, all right, really what we're doing is this is just another way of a look back into the applicants to see, was there potential fraud in the application process? And it's okay that if your reality, again, Jack theory, they might say it's okay if your reality turned out better than you thought it was going to, but the argument is, isn't that a windfall to you in comparison to others who really needed it if you really didn't need it? And I think that that is possibly where we go, but there has to be filtered into, well, why didn't you really need it? Again, all those things we talked about, half an hour ago about, were you financially frugal? Did you make the right decisions? Did you have some cash in the bank that really shouldn't be deemed as another source of income, because in a different world, different circumstances, that money may not have been there, but for the decision that you made on January 25th to leave it in there instead of pulling it out. So I think that there has to be a serious look at what are they going to do with this information that they get from those who have to fill this form out.
Yeah, I'll give you a real world example within our client base. If he's listening, he knows who I'm talking about. But if in North Carolina, I'm going to play an attorney on TV for a minute, Jack. Your favorite kind of attorney, a domestic attorney. In the state of North Carolina, what you brought to the party, which is your marriage, is yours to keep after the divorce. So let's say I own my S corporation and it's a good S corporation. I get married. I kind of used it, as Jack has always said, hey, I use the money as my piggy bank, and even then I have gone ahead and, distributed out cash as I go along. Piggy bank meaning like, there's no rhyme or reason to how I do dividend distributions. And I find out I'm about to get a divorce, and my spouse just is being obstinate and fighting me on every single thing. Well, technically the S corporation isn't party to the divorce, meaning it's not included. I had it before we got married. But what about the excess cash in there? Because that was an arbitrary decision to do a dividend or not. I mean, if I'm the spouse's attorney, I'm going to come after that, because I'm going to say you were just withholding cash, especially if you had a pattern of doing dividend distributions and then you froze them because you didn't want to create any more community property. Well, I mean, technically that's extra retained earnings that I could have used to keep people employed, and I didn't need the PPP money. I mean, it's just so ridiculous.
So we've got a couple more questions in here. One's from Phil. How's the advance payment of EIDL forgiven?
It's on your application. So since it's bundled up with the loan proceeds, one would assume that it follows that those expenses will not be deductible either, since it's all part of the same forgiveness application. Thank you, Treasury.
Yeah. Hopefully it will. This may be a dumb question. Is the PPP worth all the aggregation that this is creating? We were awarded $30,000 in PPP. Right now we can repay the loan and forget the drama.
It's still
the loan and moving on.
Look, your worst case scenario, which is kind of why the IRS is taking this position, is it's still free money. I mean, it's just not 30 grand. It's now, 30 grand,
minus
times 0.7. Yeah. So it's, why would I not keep the money? If I want, you're basically getting mad about, hey, someone gave me a briefcase with 30 grand, or someone gave me a briefcase and said, no, sorry, it's not 30 grand. Actually, it's only 21. It's still 21 freaking $1,000. Yeah. But I think to our point that we've been making is that if you took on the loan proceeds on the basis of, I've got to, let's say it's not 30 grand. I mean, that's still a lot of money, but let's say it's, $1 million, and you kept people on the job that you otherwise might not have, trying to be a nice person because you got all this money made available to you, to then find out that you got to pay 300 grand on it. Well, if you would have freaking told me that in the beginning, I might have made some different decisions on the way. So I would have had 300 grand to pay you, because right now I spent the full $1 million on payroll. That's not right. I mean, that's just not right in anybody's world.
I agree. So we are at 12:01, exactly 1 hour after we started this baby. Just as a reminder, we're going to be with our families on Thanksgiving, or at least it's just going to be me and my wife now because all of our family thing has been canceled. And I just saw a CDC note that came out on the phone while we were on this, that saying they're discouraging all travel. So you do what you need to do, but I hope every one of you have a great Thanksgiving. We still have a lot to be thankful for, even though we've been ranting. So thank you guys for being here. I will change the reminder so that we'll remove it from next week, but we'll be back here on the same bat channel, same bat time on the 3rd of December. Man, can you believe that we'll be in December already? Tim, thank you for being on here. It's good to see you too. Nice little chat there. And any parting thoughts, Jack or Adam, before we go?
Still waiting on my St. Patrick's Day at Tiber Creek that I thought was going to happen, 2 weeks later.
I hope and pray that everybody who's on here has, take some time away and really focus on the important things next week. And maybe in 2 weeks we'll have something solid. I mean, today was a great conversation. There was some new stuff, and hopefully we tackled the burning question is, in all seriousness, should you proceed or not? And at least for the next week, the answer for me is no. And even beyond that, there's just so many unknowns and so many ways that this program may change that we should, kind of stay the course. And there's the exception that if you're in the money and there's nothing else that you can do that is going to be beneficial, then maybe you do that. But there doesn't seem to be a reason to rush. So I will leave you with this quote that I found, that we must not try to sink beneath our anguish, but battle on. Now, if you know where that was from.
That's got to be a Winston Churchill.
No, not as that is fiction rather than nonfiction, but
okay,
it's the the one that Gandalf gets confused with, at least in the Lego world.
Hey.
Dumbledore. Yes.
Yeah.
Here's another kind of last minute chat. And so Jacob, thanks for sending this. Will you have other subjects discussed, like carry forward losses?
Excuse me. Yeah, we can definitely hit on that in the next webinar. We also did our tax planning webinar yesterday that you could hit on our YouTube channel, where we did hit some of those subjects.
Yeah, so go to the BGW CPA YouTube channel. We did just launch it, and it's got a graphic that says 2020. I don't remember what else I created the graphic, so I don't even remember what it was. But it's actually pretty good live Q&A session as well. So anyway, but yeah, we anticipate that we're going to continue on with some form or fashion of this webinar, even as PPP lingers or maybe fizzles out at some point. Just having a forum with other business owners and having live Q&A seems to be helpful. And so as long as it's creating value for somebody out there, we're committed to doing it, because we want to see businesses succeed, whether you're a client of ours or not. So thank you for what you do. Happy Thanksgiving early to everybody. And if you guys are okay, we're going to go ahead and sign off.
All right. Thanks, guys.
Thank you.
All right. Have a great day. See y'all.